All right, let me ask you something. Are you ready to finally stop wishing that you can invest in apartments? Are you ready to stop watching everyone else build assets and get passive cash flow and live the dream? Well, good, you are in the right place. Go grab a pen and paper. I have so much information to share with you, and I am so excited to be here with you today. Listen, this webinar is for you if you want the keys to the castle to create anywhere from 2,000 a month to 10,000 a month or more of passive income in your life so that you can take care of your family, eventually quit your job and have total time, location, and financial freedom. I'm Stacy Conkey, and I'm going to be your instructor for today. The thing that I like most about apartment investing is that there's just no limit. The big players do this exact strategy that you're going to learn today to buy 500 unit apartment complexes. And here's the good news. Today, I'm going to show you exactly how to get started in apartment investing to go as far as your heart desires. I'm going to break the process down to easy to understand steps so that you can get clarity and start working on getting your first apartment deal. Welcome to the Warriors of Wealth webinar on how to get started on apartment investing. We are Jen and Stacy Conkey, and we are incredibly excited to be on this webinar with you today. So we've been investing in real estate for 17 years and have built a multi-million-dollar portfolio in 14 different cash flow markets across the US. And you know what? We started with nothing. And since then, we've helped hundreds of students do their first deal and start living the passive income dream. So we're going to be diving into exactly how to invest in apartments to build consistent cash flow and increase your net worth, all from the comfort of your home, working fewer than 10 hours a week. We're going to be diving into exactly how to get started investing in apartments in just a second. But before we get too deep into the content, I want to tell you exactly who this class is for so that you know that you're in the right place. So this webinar is for you if you've been wanting to invest in apartments, but not entirely sure how it all works. You're in the right place. So if you have smaller properties, but you're looking to expand, you're in the right place. Or if you want to find deals that make you more profit. So Jen and I live in San Diego, California, and I'll tell you what, the only cash flow we're going to find here is negative cash flow. So sometimes you might already be investing, but maybe you need to invest somewhere else if you really want to scale. If you've been researching, watching videos, reading articles, just trying to piece it all together, but you can't quite seem to figure out how it all fits, you're in the right place. Or if you want to create consistent monthly cash flow, build your net worth, and get this step-by-step playbook by someone who's been doing this successfully for 17 years, this webinar is for you. Or maybe you've been wanting to get started in apartment investing, but you find yourself stuck in analysis paralysis, and fear is just holding you back from being able to take confident action. Or maybe you've taken other real estate courses and frankly, you just haven't been able to gain any traction. Look, if any of this sounds like you are in the perfect place because we're going to be diving into the details of apartment investing to build passive income and increase your net worth in this webinar. And if you stay till the end, I'll show you our best way of finding apartment complexes for sale so that you can get deals sent to you every single day. So I do also want to talk about who this webinar is not for. And if you match any of these, this is probably not the best way for you to spend the next 45 minutes of your life. So if you don't already know that you're interested in doing real estate, this probably isn't the best webinar for you. I will not be spending any moments of time trying to convince anyone that real estate is the way to go. If you're here and you're staying here, it's because you already know that you want to build wealth in real estate. This is also not for people who just have more excuses than desire to succeed. Look, we are about taking action and empowering you to get results. If every opportunity you're given is just met with an excuse of why it won't work, this is not going to be a good fit for you. We are about making things happen. This webinar is also not for people who are just fine with the status quo. I'm assuming that's not you if you're here. It's not for people who don't want more out of life. Look, if you want to have more, you must become more. And that's part of what we're going to be doing here today. It's also not for people who aren't willing to put in the work to build their long-term wealth. This is time to learn a new skill. You have to be willing to go through that learning process to get there. I'm willing to teach you. You have to be willing to learn it. So if none of these match you, cool, you're in the right place. So imagine what your life would look like if you had the clarity on the exact steps to go from, man, I wish I could invest in an apartment someday, 2, I just closed on my first apartment building. All of this while working from your laptop, less than 10 hours a week. We're going to be breaking down exactly how this works in just a few minutes. So in the next 45 minutes, I'm going to show you these 3 big secrets. And it's stuff that we've learned over the last 17 years. The first, how to make money with apartment investing, regardless of whether the apartment building is already making money or whether it's a total dog in total disrepair and needs a lot of help. Second secret is I'm going to show you our proven strategy to analyze apartment deals so that you have complete confidence and you're not held back by fear of your ability to make the right offer because you know how the numbers work. The third is I'm going to teach you how to make a risk-free offer like a seasoned investor so that brokers will take you seriously and continue to bring you more and more deals. Plus, as a little bonus, if you watch to the end, I will show you how we find the best apartment deals in the hottest cash flow markets using remote real estate investing. So we're going to show you how to buy your first apartment building. Even if you have no real estate experience, you don't need to be a realtor or a lawyer or a CPA to know how to buy an apartment building that provides you consistent monthly income and takes care of your future retirement. We're going to show you that in this webinar. We're also going to show you how to choose the best strategy and market based on your goals, based on your resources, so that you can start converting all of that random information you've been gaining into an easy to follow system that will allow you to do deals over and over. We're going to show you how to beat your competition by making no risk offers that allows you to lock up a great deal, have time to really dig into the details, and frankly, if you don't like what you find, you renegotiate or you simply back out, no money out of pocket. And all of this is while working from your laptop in your bunny slippers, if you want, from anywhere in the world. And it's really anywhere that you have an internet connection. Are you worried about not having enough funds to do an apartment deal? Well, no problem. We're going to show you how to fund your apartment deals without having to do a deal with the complicated SEC regulations with syndication. We're going to show you how to fund your deals without syndication. Now, what makes this webinar different? Well, frankly, there's just nothing for sale, just proven content and strategies that will revolutionize your real estate future. But before we dive into everything, I just want to show you what's possible when you actually implement the strategies that we're going to be talking about today. Now, what I'm about to show you is screenshots from our actual mastermind chat string in Facebook Messenger. It's showing people just like you who are using our system to launch their businesses. So let's get into these. All right, so this was Battelle, who bought a 9-unit motel that she's going to be doing Airbnb through. And she had sent us a message saying, hey, I got a $70,000 price reduction. Like, that was amazing. And then this is her closing, signed. There's Battelle holding the keys to her new motel. Then we had Joni, who is Regina in Facebook, saying, cheers, received a $50,000 reduction from seller. We were so excited. It's funny because a lot of times people in our mastermind, how they communicate excitement with each other is through gifts. So you're probably going to see a lot of that. So she got a $50,000 price reduction. And then here's her right after they closed saying, thank you so much, Kimberly. I'm so happy to have found Stacy again, Jen, and you. I had really given up on real estate. Then I started listening to those dang videos on Facebook with Stacy. I felt like they were on 24/7. I took it as a sign to possibly get back in. Happy I did, and we'll talk soon. And she just closed on a 6-unit, and she is days away from closing on another building that's 9 units. We were so excited for Joni. And then there's Bobby D'Alessio. Started with just our 14-day challenge, ended up closing on a 12-unit portfolio just 4 months into our mastermind. And then here's Steve Caro. You're going to see a lot from him. This was at the beginning of his apartment journey when he submitted his first letter of intent, which I'm going to teach you more about later in this webinar. But he submitted his first LOI on a 24-unit in Miami. That one didn't work out, but a week later, he reports, I have an accepted LOI on 16/18 units in Miami. Here we go. So it was officially a 16-unit, but it technically had 18 units in it. So we call it the 16/18 unit building. So he got an offer accepted. Then there was Temmie. This was 3 days ago. Not sure if everyone's aware, but I've got a really great 6-unit deal in Hartford, Connecticut for $340,000, and I need to raise private capital to close by November 30th. And then there's other members of the mastermind who are asking questions, because sometimes people in our mastermind end up partnering together. Maybe one person just ends up having a great relationship with someone and they find a deal that nobody else would have found because it was off market. So sometimes our students end up working together to do deals. And then Amalia totally surprised us yesterday with big news. Got 30 doors under contract in Missouri. And I was like, wait, what? I didn't even know she was working in Missouri. Anyway, so exciting. Then Steve giving us an update on his Miami deal. So he said, I asked for a price reduction of $90,000, gave him the quotes for repairs, etc. He's a general contractor. He said he could get it done for $45,000, and he agreed to that in a price reduction. In addition to that, I got a 1-week extension on my due diligence. Yes. So that was exciting. And this is a day ago. So Steve had an annual hunting trip scheduled, and he's in the middle of this deal. But he does have Wi-Fi. He's close enough to civilization. So he sent a picture to the mastermind string, which we call the apartment gladiators, saying, I'm actually in a tree. I just signed the addendum. I've talked to title twice and my broker 4 times in the past hour. They probably think I'm strange talking softly. So here he is. He's still doing real estate investing. The thing that's amazing about Steve is Steve has already closed 10 deals in our mastermind in the 1 to 4 family arena. And then he was like, you know what? I think it's time for me to go into apartments. And now he's hunting in a tree, apparently with a bow and arrow, and working on closing the 16 unit in Miami. It's amazing. And then we had another update from Steve. This was just yesterday, update on the Miami deal. Due diligence ends today. I negotiated a lower down payment now and pay the rest in 2 months. So he's closing this in 2 weeks. This gives me more time to raise a little more capital. I know there were a couple people who wanted to get in on this, but needed more time to get the funds. So there's still room for an investor or two. Feel free to message me. So again, this is within our mastermind. We have a few people who end up working together. And the really cool thing is, Steve's the one who found the deal, but let's say that 2 other people end up joining him in the deal. All of them on their resume get to say they own a 16 or 18, however they decide to do it, unit apartment building in Miami. And it's a value add, it was seller financing, like so many incredible things about this deal. So our students they're just killing it. And I just want you to know what's possible for you. So let me ask you something. Do any of these things sound like you? Are you tired of having apartments on your someday list? Are you confused by all that random information out there? I know I was when I was new. Do you feel unclear about what to do first, second, and third along the way? Or are you afraid of making a mistake and losing money? Or have you been stuck in analysis paralysis? So common. Look, we know what it's like. We've been where you are, and we want to show you what works for us and our students. So here's the exciting news. This is exactly what we're going to be showing you how to do in this training. Start investing in apartments, building cash flow and equity. We are Jen and Stacy Conkey, and we are the founders of Warriors of Wealth. We've been investing in multifamily real estate since 2003 in 14 different markets across the US. All of our investing has been done remotely for 17 years. So Jen was a leader in corporate America for 22 years, and she was investing as a side business throughout her entire career. She was able to retire and focus solely on real estate. I'm Stacy. I was the CFO, and I left corporate America to invest in real estate. And I've been coaching investors for more than 10 years. For me, teaching and coaching through the difficult parts of the journey of real estate investing is an absolute purpose and passion for me. And I love doing it, which you'll probably be able to see throughout this class. So Jen and I have combined our skills to create Warriors of Wealth investing coaching and mastermind. And we are truly honored by you spending time to be here with us today so we can really help just accelerate your results. So we're really passionate about real estate investing, and we've had the opportunity to speak on multiple stages to thousands of investors across the US, sharing our knowledge and teaching our proven process. And although we've created a multi-million-dollar portfolio, we were once in your shoes. We started by acquiring small multifamily properties that were the ugly kid on the block, or bigger buildings that needed a management turnaround, and we truly developed a knack for adding value, which allowed us to create consistent monthly cash flow and build equity along the way. And once we dialed in our process, we just kept repeating it over and over and over. And look, we've never stepped foot in any of these properties, yet they bring us a consistent source of passive cash flow every single month. And it may surprise you, yeah, we have 4 kids. We're not like the gurus that are going to flash you a bunch of fake Lambos, mansions, or yachts. What's important to us is experience, freedom, time, and family. So living in San Diego and building a cash flow portfolio remotely has given us freedom, time freedom, location freedom, financial freedom, so that we get to actually enjoy raising our kids, seeing the world, and creating lasting memories. And whether it's catching a baseball game, taking mopeds around an island, or flying to New York on a whim, or being chased by a T-Rex, or visiting the temple in Hawaii, going parasailing, or maybe just taking our parents on a cruise, or chilling with a dolphin in the Bahamas. Investing for us is about experience and life and freedom. And we're super passionate about sharing that with you so that you can have the same for yourself and your family. So there's 4 areas of apartment investing that we're going to be covering. The first is matching up your market with your strategy, how to analyze an apartment deal, how to make a risk-free offer like a seasoned pro, and how to raise funds for apartment deals without doing syndications. So the old way of doing real estate was watching a bunch of random YouTube videos to try to figure out how all the pieces fit together, and then mailing letters to look for apartment building owners and trying to somehow find a deal and pretty much getting nowhere and just stumbling through all the numbers, unsure of which are relevant and what it all means, and getting stuck in analysis paralysis, never moving forward, never making offers, and never closing on apartment deals. The new way of buying apartment buildings is leveraging relationships to build your real estate empire quickly and easily so that you could do an initial analysis to determine whether the deal is even worth looking at, and then how to determine the right offer price and actually making the offer, doing your due diligence, and closing the deal. So let's get into it. Focus area number 1 is going to be about your investing strategy. So there's 2 investing strategies that are the most profitable strategies. The first is stabilized and the second is value add. So with a stabilized building, what that means is the tenants are already in place, the units are occupied, money's already coming in. It's a performing cash flow building. In multifamily real estate, we call that stabilized. So in this strategy, it's pretty simple, right? You put down your down payment, you close, you pretty much have immediate cash flow coming in at closing. And this is a really good strategy for you if you have capital, but you lack time. So like if you don't have time to conduct a management turnaround and make that happen, then this is going to be a better strategy for you. The second strategy, and this one is definitely our favorite, is the value add strategy. So a value add property is one where you're looking for underperforming apartment buildings. Now, underperforming can mean a number of different things. It could mean that the current rents are under market. It could be that the property is outdated, and because of that, they're under market, so you have the opportunity to raise rents. It could be that there's vacancy, there could be management issues, there could be rehab issues. There's a number of different things, but basically what you're looking for is something that it's kind of a problem, but it's a problem that can be solved through concerted effort, planning, strategy with your management company. So this is a strategy that does take more time and effort, but there is definitely more profit. It might take you more time before the property cash flows, or at least cash flows at its optimum, but it's a fantastic strategy if your goal is to increase your net worth significantly in addition to creating cash flow. So what we want to do is you want to match your market with your strategy. So we have to talk a little bit about cap rate. Now, cap rate is short for capitalization rate, and it is kind of like a return on investment type of calculation. It's not exactly return on investment, but it basically shows the relationship between the profitability of the building and the price of the building. So each market has its own market cap rate, the kind of the return on investment that buildings are selling for or trading at, which is the lingo we use in apartment world. So if you're in a higher cap rate market, that typically means it has a higher cash flow. Higher cap rate is higher cash flow. Lower cap rate is lower cash flow. But the thing that's really crazy about it is when it comes to value, it's the exact opposite. A higher cap rate means the market prices are lower. It's lower value properties. In a lower cap rate market, the properties are higher value. So it really depends on what you're looking for. If you're looking for a stabilized property, you're probably looking for the highest cap rate that you can get because it means it's going to be the most profitable. If you're looking for a value add opportunity, you want to be in a market that has a little bit of a lower cap rate. And the whole idea is you want to buy the property at a higher cap rate, make all the changes, and then sell it at a lower cap rate. A lower cap rate is a higher value. And that is part of how apartment buildings are valued. It's different than residential. It's different than 1 to 4 family. So you really have a huge opportunity through doing a turnaround to massively increase your net worth. So we're going to buy high, sell low in the cap rate department. All right. Focus area number 2 is going to be financial analysis. So we're going to get into some of the key metrics that we look at when we're evaluating a deal to see how does this deal look. All right. So the first thing we're going to look at is the net operating income. So the net operating income is going to tell you how much money this building provides on an annual basis. So what you do to come up with net operating income, or NOI, which is how it's more commonly referred to, is you're going to take all of the income from the building. So that's typically the rents, but it could also be storage income, vending income, laundry income, like anything else. Basically all the income that comes in minus all of the expenses that it takes to run the building. So if you think about it, what would that be? Property taxes, insurance, property management, maintenance, marketing fees, legal fees, eviction fees, like all of those different things that it takes to run the building. The one expense that sometimes people get confused and they throw it in net operating income and it does not belong there, even brokers do this, so it's a good thing for you to know, is the debt service, aka mortgage payment. The mortgage payment or the debt service is not included in the net operating income. So when you're evaluating an apartment deal, you're not initially looking at what the debt service is going to be when you're comparing one property to another. You're like, okay, well, how does this building just perform, regardless of how it was financed? Because someone who finances it with cash is going to have a higher cash flow than someone who gets a loan and has to pay a mortgage every month, right? So net operating income is completely separate from any mortgage, and it shows you how the building performs. The next calculation is annual cash flow. Annual cash flow is simply the net operating income minus your debt service. Now, everything in apartment world is done on an annual basis. So we don't really look at things monthly. Everything is over the course of a year. So that's an important thing to know as you get out there and start talking to brokers, so that you don't make the mistake of saying, well, what's the monthly income? They're going to be like, okay, so you're new. All right. So you always want to talk in terms of annual. So same with net operating income, annual NOI, annual cash flow. Now, the next thing that you want to be looking at is your cash on cash return. Like, how much money are you getting at the end of the year compared to how much money did it take you to get the deal under contract to begin with, or to get it closed to begin with? So cash on cash return is your annual cash flow, so net operating income minus debt service, divided by everything it took you to get into the deal. So for example, that would be your down payment, your closing costs, your due diligence costs. Okay, any money that you had to put out in order to get the deal done is part of your all-in costs. Next, we're going to talk about cap rate. The cap rate is what we were talking about when we were talking about the markets, but this is how you calculate cap rate. The cap rate is the net operating income divided by the purchase price. Okay, so net operating income divided by the purchase price, and that's going to give you a percentage. So the lower the percentage is, the lower of a return that the building provides compared to its purchase price. So if you're looking at 2 buildings and one has an 8% cap rate and one has a 9% cap rate, the 9% cap rate is going to be more profitable compared to its purchase price. Okay, now this is different than the market cap rate. The market cap rate is just, this is generally in this market what things trade for. The actual cap rate of the property, which is what we're talking about here, is the actual net operating income and the actual purchase price. All right. Debt service coverage ratio, also referred to as DSCR, this comes into play particularly with lenders. Well, not particularly, it's with lenders, right? So the debt service coverage ratio is the relationship between how the building performs, which is the NOI, So remember, income minus expenses. So what's left after paying all the expenses? And they compare that to what is the mortgage payment or what is the debt service? And what they want to see, banks are really, they're in the business to make money on lending, but they are really, really conservative and they want to mitigate risk. They don't want to lend you money on a building, have you not be able to afford to keep the building, and now they end up with the building back as a foreclosure. So they want to make sure that your deal has enough money coming in to cover their debt service plus some. So for example, if a lender has a minimum DSCR or debt service coverage ratio of 1.3, what that would mean is, let's say that the net operating income is $130,000. So $130,000 comes in every year after paying expenses. And then let's say that the debt service was $100,000. Okay, so you would take 130,000 divided by 100,000, and that would be 1.3. Okay, so basically it's 100. The net operating income is 130% of the debt service. The higher the DSCR, the happier the lender will be, and the less risky the deal seems. So in our most recent refinance, we did a portfolio refinance. Our DSCR when we refinanced was 1.6. And we could have refinanced at a higher rate and pulled some cash out, but frankly, we were more interested in the cash flow. So we just refinanced at our 70%. It gave us a 1.6 debt service coverage ratio. And how the bank rewards you with having a lower risk is a better interest rate, right? Which helped the debt service coverage ratio even more. So this is an important ratio to learn because this is going to be part of the world of the financing. If you ever see a lender that says, oh, we'll take a 1.0 debt service coverage ratio, like there's no reason you would ever want anything like that, because what that means is your net operating income is 130,000 and your debt service is 130,000. So your cash flow is zero. Well, what's the point of doing it then, right? So you're always looking for your debt service coverage ratio to be as high as possible. But usually with a lot of banks, 1.25 to 1.3 is going to be a typical minimum that you'll see from lenders. So what are the things that impact the debt service or the mortgage payment? Well, for one, the principal, and the principal is a function of your purchase price minus your down payment. Whatever's left is the principal balance. All right, your interest rate and also your amortization period are going to impact your debt service. For example, with amortization, most people are most familiar with a 30-year amortization because if you've ever bought a personal residence, that's probably what your amortization period was. So what that means is when the bank is figuring out what your monthly payment's going to be, they'll spread it out over the course of 30 years to figure out what payment would it take for you to make every single month based on this particular interest rate and this principal, so that at the end of month 360, that's 30 years, you will have a zero principal balance. Okay, so that's how the payment is figured out. Now, if you compared a 30-year amortization period to a 20-year amortization period, here's what it's going to look like. So in 30-year amortization means it's going to take you 30 years to pay it off. All right. For 20-year amortization, it's only going to take you 20 years to pay it off. Well, that sounds better, right? Well, maybe it really depends on what your goal is. If your goal is to pay the property off as soon as possible, then 20-year amortization is definitely going to be better for you. But the other thing about paying it off in 20 years, I mean, if you're going to pay it off 10 years early and you're making monthly payments to do that, what you're doing is you're increasing your mortgage payment, which decreases your cash flow. And it doesn't mean that's wrong. It just depends on where you are in life and what your goals are. If you're like, I mean, cash flow is cool, but frankly, I don't really need it. I really just want to have the asset for later when I'm retiring. Then you probably want as short an amortization period as the property can afford. But if your goal is to maximize cash flow, you want as long an amortization period as the bank will give you. Now, in the world of apartments, 30 years is possible. It's not super, super common. What you're going to see more commonly out there when you start talking to lenders is that with apartment buildings, it's probably going to be more like a 25-year amortization, where with 1 to 4 family residential, you'll see 30-year amortization all day long. So, part of it is just getting out there and making phone calls and seeing what's available. Okay, in focus area number 3, we're going to be talking about how to make risk-free offers. Now, there's really 3 different components we're going to be talking about here. For starters, in the world of apartments, the way an offer is made is a little bit different sometimes than residential. And nothing I say here is ever going to apply 100% of the time. So I want to just preface it by saying that in case you ever experience something that's a little bit different, I'm going to teach you the way things work the majority of the time. But in real estate, there's 1 billion little nuances that happen in every single deal that will be slightly different from the norm. So I'll teach you the norm, and just know that you need to be flexible enough to ebb and flow and be creative through deals, because you're always dealing with different people and sellers and lenders, and they're always going to throw extra special opportunities for you to learn into every deal. So for starters, there's something called a letter of intent. So remember earlier in the webinar when I was showing you Steve saying, oh, I just submitted my first LOI for 24 units, and hey, I just got my LOI accepted on my 1618 unit in Miami. A letter of intent is a non-binding, it's usually maybe 1 to 2 pages, and the whole point of it is just for you to say, hey, I'm putting my hand up to say I'm interested in your property, and I'm interested in the property at this price with these terms, this amount of due diligence, this closing time period, etc. So it's a non-binding document that allows you to tell a seller, hey, I'm interested. If you're interested in these terms, let's have a conversation. So it's interesting because in the world of a letter of intent, the fact that it's not actually under contract, it's a lot less structured than it is when you're in contract. So you might see everything in an LOI negotiation from just verbal back and forth to someone taking your original letter of intent, printing it, and like crossing out a couple of things and writing in what they want, and then like scanning it, emailing it back to you. It can go a number of different ways, but the whole point is it allows you and a seller to go back and forth and find, if you can, a happy middle ground that everybody's satisfied with. And then we go into contract. And I know that's different than residential. When in residential 1 to 4 units, we're typically just making an offer on a purchase and sale agreement. There's no letter of intent to begin with. Not that there can't be, it's just not customary to do that. So once you have a letter of intent that's accepted, then, and there's usually brokers or realtors involved. If not, you and the seller could do this yourself, but there's brokers involved. They'll be the ones, they will write up the purchase and sale agreement. It's usually on a state contract. One of the things that I get a lot of people kind of having fear around is, I don't know how to write it up, and I don't know where to get one. You won't have to get one. You don't have to worry about that because the broker is going to handle it. And frankly, if you really needed one, it's not too hard to find now that we have Google. So, but anyway, the broker is going to write up the purchase and sale agreement. The whole idea is that everything that was already negotiated out on the letter of intent then gets transferred to the purchase and sale agreement. But then you also include what I call the Mama Jamma Kick Booty rental unit addendum. And the rental unit addendum has a list of all of the different things that you want the seller to provide you so that you can really do thorough due diligence. And sometimes the sellers will come back and go, whoa, that's so many things. So there's a lot of things in our addendum that we ask for. And then when it comes down to it, if the seller's like, I'm fine with these things, but I'm not okay with these over here, I don't have that, it's up to you as the buyer. You might need to get some advice from your realtor at the time, or from your coach if you're working with a coach, on what should you say yes to, or what should you say, what's a deal breaker? Like what's okay and what's a deal breaker? All right, but everything in the addendum is intended so that you have all of the information necessary that you can make a clean, clear decision about how the property is performing and whether the price that you agreed to, whether that still makes sense, okay? So then now, so once you have a signed purchase and sale agreement, now you have what's called an executed contract. You've signed it, the seller has signed it. At that time, you're usually sending an earnest money deposit. That's part of what's been negotiated. The earnest money deposit is 100% refundable during the due diligence period. Now you have to make sure that that's written in your contract, but that's just the way it's typically done in real estate. So you're not at risk, but you do have to put some money up. And that just tells the seller that you're serious and that you're actually putting time and attention because you're putting your money up. It's always going to be with an independent third party. You must never send any kind of money directly to the seller or the real estate agent. It should go to a title company or a title attorney, depending on what state that you're in. All right, and then part of making a risk-free offer is you're doing due diligence. Now, there's two different types of due diligence. There's financial due diligence and there's physical due diligence. The financial due diligence is you looking at all of the numbers of the deal, the rent rolls, the T12, which is the trailing 12 months. So it's basically a monthly financial statement, but it's January, February, March, April, etc., side by side through the year, so that you can see if anything looks out of place on any given month. And it's every single line item of their financials, so every single expense. So you're going through all the financial due diligence. You're looking at the leases. You're comparing what's on the lease to the rent roll. Does it match? It's not uncommon at all to find in due diligence that the seller is saying, oh yeah, we have, our leases are good through next year. Then you look at the leases and you're like, wait a second, these already expired, you know? And so things like that, that's why you do the due diligence, to make sure you know what you're buying. And if it doesn't match up, that you can go back and renegotiate. All right, so once you go through all the financial due diligence, which not only are you doing that, you're also checking on the expenses, like you're looking at the utility bills, you're looking at property tax bills, you're getting insurance quotes, you might be looking at their tax returns, looking at their maintenance expenses. If something looks out of whack, you might ask for like proof of an invoice or anything like that. You're looking at the management fees, and is the property manager in place someone you're going to keep? Are you going to get a new one? So this is all the things that you're doing to see whether, just based on the numbers alone, does this deal still make sense? If it does, then your next step in the deal is to do physical due diligence. Now, the physical due diligence on a building, unless you're talking about rehab, with rehab, you can get a contractor in there. They shouldn't charge you because they're bidding the job. But besides getting a quote for rehab, the physical due diligence is getting a building inspection. That has a cost associated with it. So the reason that I teach you to do the financial due diligence first is because all that costs you is your time. There's no money out of pocket for financial due diligence. But once you've completed it and you're like, yeah, it looks good, then you're going to get a building inspector. You are absolutely never, you better never, ever close on a property without getting an inspection, because that's a mistake that could cost you easily multiple 5 figures, definitely up to 6 figures. And that is not the way that you want to be starting your career. So you're always going to get an inspection. They're not cheap. Depending on the size of the building, you're looking at, you know, anywhere from $2,000 and up, frankly, if you're an apartment building. So, well, maybe not that, but it just depends, but it's not cheap. It's not like a $350 house inspection, right? It's more. So you want to make sure you've done everything you can before you spend that money. Then when you get your building inspector, you go through your entire inspection report with your building inspector, make sure you understand what it says. And now you're going back and seeing, do I need to go back and renegotiate the price? Okay. And if you do, then you go back to the seller, and you saw 3 different examples in just the screenshots I put up of just the couple I threw in there. Patel got a $70,000 price reduction. Joni got a $50,000 price reduction. And Steve got a $45,000 price reduction. All of those came from doing the full due diligence on the building and going back and saying, hey, this building isn't as great as you made it seem, so we need a price reduction if you want us to move forward. All right, and focus area number 4 is going to be raising funds. All right, so we talked before about how to raise funds without syndication. So let me just talk for a minute about like what syndication is. So a syndication is when you're going to pool a group of investors together, you're the main person, you're doing the deal, and you're getting people to put their money into the deal. So they're all passive investors, silent investors, they're putting their money in, you're doing all the work, you're giving them a return. So if that's the type of deal you're doing, that is actually subject to SEC regulations. And there's nothing wrong with doing a syndication, and there's nothing wrong with doing it. It's just what Jennifer and I have found over the years is when someone is brand new to apartment investing, and there's a lot of people out there that sell all day long, oh, syndication. And it sounds super sexy and super easy. There is nothing easy about it. There's definitely nothing easy about it. And it's also very expensive. So because of the complication factor of it and because of the expense of it, what a lot of brand new investors find when they start going down that path is they never actually do a deal. And that frustrates the heck out of us because we are about helping people create freedom, not just learn more crap that you can stick in your head and not be able to make any money with. So the reason I want to show you about how to fund your deals without syndication is not because syndication's bad. It's just because most people never actually get started if they're trying to start that way. So once you've done a couple of deals, you're probably going to easily be ready to do syndication. You can learn how to do it. I mean, you might even learn how to do it with us, but I'm never going to teach someone who's brand new to go try to do a syndication on their first deal because it's going to be 3 years later, 5 years later, and you're still not going to have done a deal. We're not okay with that. All right, so what I want to teach you about is doing a deal and raising funds through a joint venture. Okay, so the difference in joint venture is that when a joint venture is happening, all of the people in the deal are active investors in the deal, meaning every person has a role. So you're not going to pool your 20 closest friends, if you have that many friends. You're not pulling like a big group of people. It's maybe a couple of people, like 2 or 3 people. It could be a little bit more, but it has to be structured in such a way that everybody has an active role in the deal. All right, so the pros of that is obviously you get to avoid all of the SEC regulations. You get to avoid spending $10,000 to $20,000 on a private placement memorandum. The cons are, well, now you have multiple partners, but it's just what we have found is that our students are actually moving forward, taking action and closing deals by doing joint ventures. All right. And so that's what I want you to focus on. So let's talk about like, well, where do you find the money and find the people to do joint ventures with? Well, for one, it really comes down to building relationships. Everything in real estate is about building relationships. And when it comes to money, that is just that much more important. People want to feel like they know the people they're doing business with, especially when they're putting money into a deal. So I want to point out something that sometimes you don't necessarily recognize until you've been in real estate for a little while. Obviously, networking in person is a great way to build relationships, but depending on when we are in the world, if it's 2020, there's probably not a whole lot of in-person, networking going on, right? Because of COVID. So, but one of the great things about that is it really helped everyone to start focusing on, well, how can we network in a less limited way anyway? So if you think about it, there's all sorts of Facebook groups. I mean, you might even be in ours. There's all sorts of Facebook groups out there with all sorts of people who are interested in real estate. That's why they're in a real estate related Facebook group. So when you start networking with people in Facebook groups that are into real estate, interested in real estate, that's going to be where you want to start building relationships with people. Also, if you are not already actively posting on your personal Facebook profile or your LinkedIn profile or Instagram, wherever you do your social media, if you do social media, you want to start doing that. And let me give you an example of that. So one of the things we teach our students is, look, don't let it be a secret that you're looking to invest in real estate. And don't worry about people going, oh, I know you're new. Those aren't the people you care about. What you care about are the new relationships you're building or the relationships you already have with people who are like, oh, wait, you're doing that? I've always wanted to do that. Because look, if you're on this webinar, you are a small percentage of the population that's actually willing to invest in yourself. Right now, you're just investing time, but even that is an investment. You could have chosen to do something else with this time. So you're making the decision and the choice to invest your time to learn a new skill so that you can go out and create passive income. Well, there's lots of people that know real estate is the way to go. Everybody knows that. It's not like it's a secret and you don't have to convince anyone anything. It's not like you're like, oh, here's this new technology and it's being tested. No, real estate like goes back forever and everybody knows it's good. So if anybody's already interested in real estate, but they're unwilling to do what you are, which is learning it, they're the perfect person that you're looking to partner with. So if people don't know what you're doing, they don't even know to ask you about it. So one of the things that you can absolutely do to start, you want to do it now. You don't want to do it at the moment you need the money. You need to be doing it way sooner than that, starting now, is on your personal profile. Just, putting a picture of an apartment building, checking out this apartment building, or, hey, just had a great conversation with a commercial broker and putting like a picture of an apartment building, or, hey, just analyze this deal. Looks like it might be a good one. And it's not like you have to do it every day, but if you're doing that a couple times a week, you're going to start getting people's attention. The other thing that you can do is when you are, and maybe you don't use Facebook for the purpose of networking, I'm going to teach you how to do that, how to use it as a tool, how to always be marketing, right? So you're using Facebook as a tool. If you go into the different Facebook groups that have, and I mean like groups that would be a higher likelihood of people interested in apartments, maybe multifamily groups, apartment groups, or burr groups, anything like that, where if you become friends with them and they're like, well, I don't know how to do it, but I do have some capital and I really want to, obviously, because that's why they're in the Facebook group, and you send them a friend request and you send out friend requests in all these different groups to different people, a lot of people won't accept your friend request, but some percentage of them will. And when they go to your profile page and they're like, oh, okay, I see this person clearly into real estate. Oh, they're doing apartments. How interesting. And so it just allows you to start establishing a presence and developing a relationship with people who you might end up doing business with. Okay, so finding the money is it's something you literally never stop doing. Jennifer and I are always looking for partners for our next deal. And so we do that as well. And that's something that you should do. Now, we're not always in acquisition mode, so you won't always see us doing that, but you can tell when we're in acquisition mode because we will start posting pictures of the deals we're looking at. Or if we're in acquisition mode on a deal that's larger than what capital we have available to put into it, you'll start seeing us post our deals. And you should do the same thing starting now before you actually need the funds. All right, now I told you if you stayed till the end, I was going to do a bonus with you about finding deals. All right, now finding deals, it really isn't rocket science, right? The new way of investing is doing everything remotely, from your beanbag or from the park with your, cartoon dog or on the beach. As long as you have a laptop and a cell phone signal, you can start doing lead generation. What you're really looking to do is build relationships with commercial real estate brokers in any markets that you're potentially interested in. Because look, the way that real estate is done the majority of the time is through relationships. It's not through listings. Though oftentimes you might start with a listing. You might find a listing on LoopNet or Crexy or on any other website out there and call the broker, have a conversation, and maybe that deal's no good. But once you develop a relationship or rapport with that broker and they find out, oh, hey, I have another deal maybe we could look at, that's what you're talking about. Okay, so it's about creating massive deal flow. So let me show you an example of this. This is actually something that literally came in like an hour ago. And it was one of our mastermind members, Griffin, who's new in our mastermind, just been in probably about a month or so. And he's in the process of building relationships with brokers. And he just sent on our mastermind chat string a screenshot of a conversation between him and a broker. So I just want to give you an example. This is exactly what we're talking about. So Griffin says, hi, Lee, we looked at 1324 Nevada today, and it doesn't look like that's going to work for us. However, I found 715 Nevada on LoopNet, and that one looks interesting. It looks like your company has the listing. Can I set up a quick call with you to go over questions on that one? And so he responds back, hi, Griffin, thanks for the feedback. Unfortunately, 715 Nevada is already under contract, closing next week, so things are looking good as of now. But if anything changes, I'll be sure to relay. And so Griffin's like, oh, okay, no worries, thanks. And then the other guy, Lee, says, absolutely. Oh, I've got a 7 unit we just uncovered this morning. Let me send you the one pager we have on it. This is all I have so far, but check the notes tab for more information. Please keep this confidential as we're still working to list this with the seller. So this is exactly what we teach our students to do, is build relationships with multiple realtors, because the way that business happens is through off-market deals. And oftentimes they're not going to list it unless they can't find a buyer. But if a broker has an off-market deal and they're the ones listing it, even though it's not on the MLS, but they're listing it, and then they find a buyer, they get to double end it and make 6% potentially commission. So you want to have relationships with those brokers, because those brokers are the ones that have the deals. They're only going to put it out on LoopNet or Crexy if they can't sell it to someone that they already have a relationship with. So you want to be the one they have the relationship with. And everybody in our mastermind who's got deals and closed deals on apartments, they all came from this exact type of thing. All right, so let's talk about what momentum looks like. So Kahisha in our mastermind, she's such a badass. She was a hostage negotiator, and now she's a mom and real estate investor. And one of the things she said was, being a part of the program has helped me move out of my comfort zone. Jen and Stacy hold me accountable, which I've needed for years. Marlene says, I like the weekly calls we have together as a group, and we work together as a team to analyze situations, and I recommend anyone to join this program. Brad, the best part of this group is the camaraderie and the support from multiple coaches and my peer investors. My possibilities are endless now. And then there's Natasha, who did our first 6 duplexes within 90 days. And Bobby, who acquired an out-of-state 12-unit portfolio in his first 4 months. And Battelle acquired her first out-of-state single-family home and her first multifamily 9-unit building. She just closed on that one last month. Steve went from 0 to 21 units in just over 90 days. That was with our cash flow mastermind. All of those were done remotely. He lives in Florida. All the properties were in a different state. He never traveled there. 100% of his efforts have been remote. And now he's closing on that 18-unit value add apartment deal in just 2 weeks. And then Joni is the one who I told you about before, who closed on her first 6-unit property, again, just a couple weeks ago, and she's closing on another 9-unit building in the next week. So look, you have a choice to make at this point. You can try to figure all of this out on your own, or you can learn a proven and tested process from someone who's actually mastered real estate investing and building cash flow remotely. That's what we have a passion for. So the winner's path is joining our mastermind and getting started building your portfolio and your apartment building, but with us holding your hand. So you don't have to be trapped in fear or uncertainty or in analysis paralysis. Over the next few days, we've set aside some time to talk with you and just see if we can help. We're going to talk for 45 minutes or so. We'll map out an exact action plan for you to follow so that you can get started investing in apartments. So if you would like to take advantage of that strategy session, and there's no obligation, no matter what, you're going to leave with a plan. But if you'd like to have a strategy session with us, you're going to text the word freedom to 619-373-8461. Okay, don't put quotes because our system doesn't understand when you say quote freedom, but just the word freedom. Again, 619-373-8461. I have programmed our little text thing to send you back a link automatically so that you can schedule a call and talk to us. So together, we're going to dive into your goals, your current resources, and identify the actions that you need to take in order to get you started in apartment investing in the next 90 days. And look, if you want to work with us personally and you want us to help you launch your apartment investing, and if we think it's a good fit, it has to work both ways, then we might invite you to become one of the new students that we take on in our program. And if that's the case, we'll just walk you through what it's going to look like and take you through an overview of our program that's designed to get you into your first apartment building with us holding your hand along the way. So again, text the word freedom to 619-373-8461 to book your strategy call. I hope that you have found this information helpful. We are very passionate about helping people change their life, create freedom, and just know how to have a secure future and a secure retirement by having consistent monthly income and building your net worth now. So if you know that this is a fit for you, send a text message, freedom, to 619-373-8461, and we'll look forward to seeing you on the other side.